Hello, my name is Kevin Adams. I'm a senior portfolio manager at AAM. And one of my client specialties is the InsureTech sector. And the purpose of this video is to talk about some of the issues InsureTech companies face. And I'm very pleased to welcome Cindy Powell to our discussion today. Hi, Cindy.
Hey, how are you?
Great. I thought it would be helpful before we jump into the discussion, if you just take a moment and provide some background on your roles with both insurance companies and InsureTech companies.
Sure. Well, thank you again for having me. I appreciate that. So I have actually been in the insurance industry. I hope I'm not giving my age away, 30 plus years. Started out at KPMG doing audits of insurance companies here in Columbus, Ohio, and then joined State Auto Insurance in the 90s, actually when they were taking one of their downstream insurance companies public, a large multi-property and casualty line company that, when I think I started, it was 500 million and it's over two plus billion. So really a great time that I spent there, largely on the finance side. I left there in 2016 and lo and behold, I joined Root, totally different experience for me working in the startup world. So I had been at Root almost 3 years. I was actually brought in to actually help them with their state expansion initiative. So in that time, I think I got them into like 25 plus states. In the first year, it was close to 20. So seen a lot over the years. And most recently, I'm actually working with insurance techs on the consulting side and also some intermediaries.
Okay, thank you very much for that. That's very helpful. Today, we're going to discuss some of the broad challenges facing InsureTech organizations. But before we do that, I thought maybe you could tell us what sets InsureTech companies apart from traditional insurers.
There's a number of things. Having come from the large company and then I went to the extreme to a startup, speed definitely is the one thing. And let me talk, actually, I'm gonna say one thing first. It's actually focus, because typically you're focused on one product line and it's about making that product work. Whereas a larger company, more established company, they've got multiple products. So there's a stretch and there's an internal bureaucracy that, everybody's fighting for the same capital, but in an InsureTech, in a startup world, you're actually everybody's fighting for the same thing. Well, that's overall, that's true for the large insurance company because they want to make all the products successful in the market. I think when you've got everybody focused on one product and the deliverable, everybody's voting for the same capital use, product viability, product build out, engineering resources, customer service, that kind of thing. So it's all about speed, nimbleness. And there's a lot of bureaucracy in the larger companies because that's built over the years, but also, again, it's a fight for the capital. You don't necessarily have that bureaucracy because there's fewer people typically, 5 to 6 people in the startup world. And then that grows over time. That doesn't mean that's not going to happen with the InsureTechs over time, but in the beginning, that really what differentiates them. Also the tech savviness in a large company, you kind of get married to one way of doing things. And sometimes it's hard to change people's mindset when they kind of get into to a rhythm working with the technology that they have. It doesn't mean that it shouldn't be changed or shouldn't be fixed. It's just harder to do it because you have to gain more buy-in. Whereas a startup, they're a lot more nimble and they can change things in and out, especially with the latest technology. The other thing that is, and just thinking about this, that's much different in the smaller space of InsureTech versus the larger companies is the visibility or transparency of when things go right or when things go wrong, because it gets muted when you're at a larger company, but that's not the case when you're at a smaller company. So those are the kind of like the big takeaways that I had working in 2 different environments.
Okay, great. So when investors look at an InsureTech company, do you think they should consider it an insurance company, a technology company, or some combination of both?
That's an interesting question, because that's what we talked about a lot when we were at Root. I think it's actually both, because over the years, whether you're at a small company or a large company, technology is what creates the efficiency, and it creates the experience for the consumer. So while we want to lead with the right process for the consumer, and the technology is what enables it. So sometimes we think about it backwards, right? It's the technology, but it's what's the problem we're trying to solve, and then we embed that technology and get everybody around it and fill in with people as the technology requires it. So, but understand that whether you're a large insurer or small insurer, the processes are the same. You still have to market, you still have to underwrite, underwriting being key, you still have to price for the risk, you have customer service, you have claims, you have those things, and they're not going to change regardless of what type of company you think you are. Does that answer your question?
I think it does, yes. I know in working with several InsureTech companies, the importance of the capital raising cycle. I thought maybe you could, for our listeners, explain the capital raising cycle, and then also describe the stages, and then also discuss how InsureTechs should think about investing funds at each stage of the cycle.
I'll speak more from experience, especially on the last part, but different stages. So we we read a lot in the news, and actually there was an article that came out yesterday about a local woman that actually worked at, she was the product manager at Root, who just raised 25 million, and she's actually entering title insurance. And it's interesting because she saw this problem when she was actually at another company and worked at a real estate developer company. And so she worked in stealth mode. And so behind the scenes, she had what they call seed money. So she went out and she talked to some investors, and she had this idea. And so it's all about getting those initial investors, which is the highest risk in the series, at that seed stage, because we don't know if it's going to work, right? So it's buying into actually that individual that has that idea. And so that individual can bring in other people to help support her in building the product. So that's the seed money. So it's somebody that comes with passion and an idea that's going to work really hard to make this work, right? So then the next series is the Series A, and that always comes with a little bit more money. And it's typically your seed money, it's your seed investors. And it's really about product viability. So it's the ability then to launch into the market to see if you have good product fit. And also giving you some money maybe to hire some additional resources, engineering resources, or where you see gaps that you need to bring, whether it's in customer service. So that's what that Series A money will do. You're still trying to refine your product, okay? And so you're listening a lot to your customer. So it's all about building on customer experience. And then Series B, which is they're seeing the growth, right? This is really about gaining market share, whether you're in one state or two states. And that's actually where I came in, right as we were going with the Series B at Root, and that was about a $50 million round. Having come from a traditional insurance company, I understood, this is $50 million. We just can't have this sitting in the bank. This is like not a good thing. And we already had a couple of state licenses, and I knew that our minimum capital and what we needed to hold at an RBC level, you can't spend that money. You have to keep it in the bank, or you have to invest it. So that's where we started talking about, we need to find some vehicles, and recognizing maybe some bonds aren't the right things, but when you do state deposits, the states where you have the bonds on deposit, they have very prescriptive requirements as to what assets that you need to hold. So that's when we decided to put through an RFP, and I called in an advisor that I had worked with, an investment advisor who didn't run money, but actually helped secure helped us find alternative investments or managers to help round out the portfolio at State Auto. So, and we knew that we were embarking on Series C, which came 7 months later, which was about $100 million round. And so, we literally moved really fast on this, put an RFP together, created our, the characteristics that we wanted in these money managers. And we said we need to start with one, because this is about offloading some of the work on the state deposits, but also we needed to build in that reporting requirement, whether it was risk-based capital or whether it was Schedule D reporting. We needed all those capabilities because we had to report to the states every quarter. So there were different characteristics that we were looking as far as investment managers. So some of those things that we looked at was organizational back. Let me stay in the series. So then as you continue to grow, there's a Series D, Series E, and there's multiple series. And it's all about, at that point, it's all about funding, whether it's diversifying your product line, or in our case, it was about the risk-based capital need. And so we started using a combination of, because you never want to have your money just sit there when it's coming from a venture capital firm. What you want your money to do is maybe from a debt structure or even a reinsurance structure. That's where you want to manage your capital from a risk-based capital perspective. So hopefully that answers your question on the series. But turning to the investment portfolio, it was about, when we were amassing all that money, it was about starting to put it to use. So before I go on, are there any other questions on the series?
No, I think you touched on all the series, and that was very helpful. And then I think now maybe we'll focus on, and I think that's where you're headed, as that money is coming into the InsureTech company, how should they think about investing that?
Well, if they are, I always say money in the bank just sitting there, and we all know just money in the bank isn't paying anything today. So it's are there vehicles out there that maybe we can stretch our risk tolerance a little bit, but not necessarily bring more volatility to the income statement or balance sheet, because you're growing, your product is growing, and you're not necessarily making money yet. And I'm talking from either a cash flow basis or a P&L basis. So what you don't want to do is bring more risk to your capital structure. So that's where the money managers, because they have more freedom in the market to look at things, but they can also model those things out because they have the tools and the techniques to help you figure out how much risk-based capital are you going to lose, or are you going to need in excess of maybe the income stream that's coming in. So those are the capabilities that are really important. The states, especially in those initial years, have a pretty low risk tolerance for any alternative investments that are really on the high risk spectrum. So you have to follow, and you have to file this with the state, especially when you're going into the state new, or if it's a Form A acquisition, how are you going to do your investment? So you have to follow your investment policy with the state. And usually it's very prescriptive, and it's actually in the state codes. So there's very little wiggle room for you to get like really crazy. Avoiding equities, because that really brings a lot of volatility. And we've seen that over the last couple of days, especially with the variant, and who knows where that's going to go. So you want to work with the experts out in the market that really understand different structures and that can bring things to the table. For us at Root, it was very important for us to have someone that had insurance knowledge, insurance experience of working with companies like us. And you might not get that in a traditional investment management company. So you just need to keep that in mind.
And I think that dovetails into the next question I was going to ask you. In terms of selecting an investment manager, what should InsureTech companies consider when deciding on an investment manager for their portfolio?
Um, well, we put a criteria list together, sort of like our checklist, and and then we ranked them as we went out into the market to look at these investment managers. We wanted to understand the organizational background. I think that was very key. Like, how long have they been in business? You know, did they just pull this together yesterday, or have they? And what types of clients are they working with? And what was truly important to us was their startup experience, because we're not like a traditional insurance company where maybe there's a little bit more risk tolerance. But it was really about stepping into investments with us. And so we actually had them give us a scenario, actually in their response back to us. Like, how would you invest in a startup like this? So we talked a little bit about investment strategy. We also wanted to understand about their process, and who the team was that they were going to put on our account, the years of experience. The other was other capabilities that they can bring to the table, and such as some investment accounting, RBC analysis, cash flow analysis. Those things, cultural fit definitely was important to us. So we wanted to make sure that they were responsive, and that if we came back with some crazy ideas, would they push back on us? And so, but we also wanted, because we weren't putting all the money into the insurance company when the money came in, the 150 million came in the door. We actually held it out at the holding company, because you don't want to put more capital in than what you really need to manage your risk-based capital, especially as a startup, because it's, once you put it in, it's hard to take it out. So our investment manager was also helping us with what was being held at the holding company. So we wanted so we kind of had two arms there. A place where we could take a little bit more risk, but not so much risk that we weren't going to lose the principal of the 150 million that came in the door. So principal preservation was really, really important to us. And the principle of funding day-to-day operations of the insurance company, if we could achieve that, especially in this low risk environment. So, our issue was we were operating in a low risk environment. So sometimes that's just the way it is. So hopefully that's helpful.
You mentioned the preservation of principal, and that's an important thing, especially for InsureTech companies as they're starting out. They tend to have a high need for cash early on, and there's a greater amount of cash burn than maybe a mature insurance company.
Right.
How do you think InsureTech companies should look at surplus strategies like investing in equities or alternative investments? When do you think that's an appropriate investment for those companies?
I think one, there's I always think, and maybe I'm just more conservative than others. When you see positive cash flows from operations, and because that's typically a precursor that you're going to have income down the road, I think you can take a little bit more risk. You can be a little bit more risky on the risk spectrum. The equities, I would say you better have a pretty strong risk-based capital number. 300% is not it. I would say probably, somewhere above maybe 500, because, that equity can drop to zero, right? And while that's probably a really far-fetched example, any loss in capital, if you're so close to 300, and why 300 is important, we can get to that down in a few minutes, but 200 is definitely the cutoff. You have to have the cushion to absorb that, what is hopeful temporary volatility. And we saw that right around 2008, and where equities dropped and so many companies were taking impairments. And especially on the statutory side, they don't let you write impairments back up. if the asset should recover. So you have to live with that until you sell the security. So to me, that's a little bit more risky. And so I would say until they get to profitability, I wouldn't touch an equity.
Okay. Yeah, that's been our experience too with the companies that we've worked with, is that need for cash in the early years is so high that you need to have very liquid investments because a lot of that series money that comes into the account will actually end up, quite a bit of it goes out pretty quickly too.
Yes.
I'm going to shift gears here a little bit. I know one of the things that you talked about was going into other states and expanding. Mm-hmm. Maybe you could tell me a little bit about your experience in getting licensed in those states, and maybe some of the things that you wish you knew before that you know now that you could help with any other InsureTech companies that are looking to do the same.
I'll tell you, that was the most fun part of my job. Every state's different. Yes, aggravating at times, but it's a true barrier to entry for sure. One thing that so the process isn't necessarily different between states. I mean, getting up and running as a primary insurer in a state is always the hardest, right? So if you're getting your initial license in your first state, that will be your domestic state. And most of these states are the same, but they will leverage the work that your primary state did. Having a really, really strong business plan that hits on a lot of different risk management capabilities, and also where you think you're going to be over the next 3 to 5 years. And that has to be supported by 3 to 5 years of pro formas. 5 years for some states, not all states. It's typically 3 years. And then executing to that plan. So I always said your business plan is the rock to your execution. So it becomes the thing that you are going to execute to. So hopefully it gets communicated to the people that are actually working with you on your product. So don't underestimate the amount of work that goes into a solid business plan. It will also minimize the number of questions from the department. The surprising thing was all departments are different, they're staffed differently. And this was probably, and I knew this from State Auto, but when you're trying to get licensed into so many states at one time, it really surfaces itself. They're all staffed differently. And there's 4 quarterly filings a year. March through probably end of April is a very busy time because some of those staffs are working with annual statement filings and reviewing them and working with their domestics. So they might put on hold any of the filings that come in for COAs, or what we call certificates of authority. The most frustrating thing was seasoning, and the number of seasoning states out there where you have to have 3 to 5 years of experience. Well, for InsureTechs, they're fast movers, right? They have no patience for that. and so you have to figure out a way or have some sort of, and this isn't going to work in most of the states that have seasoning because it's pretty black and white, but some states will consider waivers. And so you have to work through that process. And it's about identifying people in the state that have a good relationship with a department that can actually lead. We did a lot of visiting to states, meeting with them in person. I think a lot of them had turned to Zoom in the meantime, so that they truly understand you before your application comes in. That will actually make the application process that much easier. Their goal is to make you successful and to be there to support you. And they are your advocate, but they are also your watchdog. So you can't, they're not your business partner, okay? But their role is a public service to the community, to the state, and they take their role very seriously. Their jobs are twofold: to provide a solvent market for insurance, and they take that role very seriously. And insolvencies have actually diminished significantly since they put RBC together and they put in different structures to really monitor companies over the years. The other is the protection of the consumer from unfair trade practices and meaning marketing practices. And again, so they will take their time to really understand you. So before they actually grant you that certificate of authority. And that's frustrating for investors because they want to move fast, especially when they know that they have a product that they want to put to market. One of the things that was a little bit, in the department's getting better at this, but it's also slowing them down, is they want to know who is the ultimate owners of the entity. So the insurance company, they look all the way up the ladder to see who's putting the money in. And if there's an ultimate controlling owner, and they define that as 10% or greater, there's a lot of work that goes behind understanding who those ultimate owners are. So much so that they have the right, and there could be potential to ask for financial statements of those individuals. So that last piece, really understanding that ownership structure, can really slow the process down if the investors don't understand how insurance companies and getting licensing actually works.
That's really interesting. I didn't realize how deep a dive each individual state took into the owners of the company.
Yes, and if you think about some of the disruptions, like the Enrons of the world, I mean, we all feel the effect of it, right? It doesn't matter what industry is, but when you're a regulated entity, and we're all about protecting the consumer, okay, because ours is a promise, whether it's title insurance or it's health insurance or it's P&C or life insurance, it's a promise to pay in the event of something happening. So that promise has to stand for the duration of the contracts, right? So that's why they want to know that all the way up the food chain, there's financial stability.
Sure. I wanted to ask you about reinsurance. Reinsurance is something that for traditional insurance companies is a very important component. For InsureTech companies, do you think they get treated a little differently? Do they pay higher rates because of their shorter underwriting history? Maybe you could tell us your thoughts on that.
Oh, definitely. You also might not get the bigger players to take a risk in you. So they do a heck of a lot of work before they underwrite you, and they'll take you on as part of their reinsurance program. Almost every company, unless you have the ability to be self-insured and you have, you've got a big bank behind you, backing you. You always want to protect yourself in the case of an excessive loss or a shock loss. So having an excessive loss program or a stop loss program. In the P&C case, it's always a CAT program. Yes, they're going to pay a higher rate because you're an unknown. And, there are investors out there that are reinsurers that also do the reinsurance. So because they have the faith, right? And they know that, they're willing to take that risk on both sides of the balance sheet. So there is the higher rate. They also want you to have skin in the game. So if you have to do a quota share to manage your growth, they're not going to let you cede off 95% because then you look more like a fronting company. And even your state might question that, why are you really in business then? So if you're not going to retain some of your risk. So it's a real dynamic discussion. Sometimes you will see, especially in the InsureTech space, some unknowns coming in, some unknown reinsurers. And so you might have to write some unauthorized or bring on some unauthorized parties who then have to back it, for you to protect that credit risk. So that gives them a leg into the market too. So as a reinsurer, because you first come in typically as an unauthorized reinsurer. So, those are usually higher rate structures. So yes, but if you get in with some of these good brokers, whether it's an Aon or a Willis or whoever it is, they have great modeling capabilities that you can utilize, and they will actually help you maybe identify some areas of weakness that you need to build upon. So having that outside view with those brokers actually is always a good thing. So you definitely, in my opinion, you have to work with a broker when you are InsureTech and not go directly to companies.
Great. One of the current themes that we're seeing in investments and in insurance is environmental, social, and governance considerations. How should InsureTechs be thinking about ESG considerations?
Yeah, there's a lot of time and discussion. I mean, I am a CPA, so I'm required to have continuing ed, and I mean, there isn't a day that goes by that I get something about an ESG, CPE conference or a continuing ed. It's interesting. I think it's always been there. It's just how we elevate it. So when I think about, I'm going to focus more on the societal thing. I think a lot of these InsureTechs right now, it is about societal. They're trying to solve a problem, right? They're trying to solve a problem that they think is either unfair or broken, or just an old infrastructure. So maybe that's where the broken comes in. We used to say, gosh, P&C insurance is broken. But what does that really mean? Because people are still buying it. It's just, it's not either cost effective because the systems are old. They're still running on COBOL programs or mainframes, and they're not using the newest technology. So they're having to staff it with a lot of people. So I think about Root because I think it's a phenomenal model with their telematics. And I think that's trying to solve a societal problem about how do we make insurance fairer. So isn't driving an auto all about driving behavior? You see it in commercial insurance on the commercial auto side that they underwrite to the driver. So it's about the driver's MVR report. And so, Root's pulling real-time data to really understand from day to day how an individual actually drives that car. Another one that most recently, is hitting the market here in Ohio is Circulo. Medicaid is definitely, we understand it. It's a very complicated industry, and it definitely is broken. There's a lot of friction within the Medicaid model. And with Circulo, they just got licensed in Ohio as a Medicare insurance company. So we'll see some action there. They're doing some innovative things outside of trying to get healthcare into areas of Ohio where you have high Medicaid recipients, because they might not be able to travel to the better hospitals or the better doctors. So that's where InsureTechs, I think, really are making a difference. And the larger companies are having to try to pivot to be more like what the InsureTechs and their narrative has to change a little bit.
Thank you. When we think about the board of directors for an InsureTech company, you probably have more venture capital involved. They're newer companies, maybe a more aggressive mindset. How do you think, is it more challenging with an InsureTech board of directors to explain the regulatory nuances for insurance, the insurance industry? How do you handle those challenges?
Oh yeah, it definitely is challenging. And I think it's really important when you're bringing an investor into whatever series that you explain who you are, what your company is, and why you're doing what you're doing, and that you are a regulated entity. And so what does that mean? What does that mean from a capital requirement? What does that mean from a transparency requirement? And investors have all these metrics they want you to follow, right? And then you load that on with with what the departments or the insurance companies are required to follow, risk-based capital, hazardous financial condition, leverage ratios, all these different capital metrics that have evolved over time. And sometimes they conflict. And it's frustrating. But if you can bring an investor in and help them understand that there are constraints that we have to work on, and feeding the monster, I call the risk-based capital requirement the monster, because nobody likes it, right? It's like this big black box that nobody really understands. But it's the model of risk that the company is working under that you have to stay above, or else your regulator can come in and take you over. Nobody ever wants that. So the better that we can educate the investor prior to coming in, and they'll get a taste of that if we have to go up the food chain and they have to turn over their personal financial statements. So, but ironically, both the department and the investors and everybody in the company, we're after the same thing. We want to get a better product out into the market. We want to get a more cost-effective product into the market. So if we can all work together and understand each other's requirements, one's a mandate, and the other one is sometimes you just have to live with it. But hopefully it's the meeting of the minds. So it's a push and pull.
Sure. One of the things that we've seen with the pandemic is many of these technology companies have grown tremendously. They've actually benefited quite a bit as a result of the pandemic. What have been the unexpected consequences for the InsureTech industry as a result of the pandemic?
Well, it's interesting. We have seen a lot of activity since the pandemic hit. One, because I think people just wanted to do something different and they saw a problem that needed to be solved. So they're creating a lot of different companies. Probably some of the unintended consequences is because, when you're so focused on your cash in the bank, and then the state comes in and puts a moratorium on premium collections in certain areas or certain states, and you have to live with that. And you see sometimes in catastrophe situations, if a hurricane comes through or a tornado, some states will put in certain zip codes, some of the departments put a moratorium so that you can't cancel policies. And so you're like, hey, but that's like paying the bills here. It's paying claims, but you can't stop paying claims. So that might have been some of the situations that some of the companies might have hit. That was unexpected. So moratoriums they're just interesting, but sometimes very well intended. The other, I think one of the unexpected, and we actually saw this in the large companies too, is the increased costs when it came to claims. And that we saw that in the auto market, just because they can't get chips or they can't get products to repair cars, so they sit in the garages longer, and they're incurring rental costs, and then there's a cost to store, and so and then the products itself, they're just going through the roof. So that was never baked into the pricing. So there's a lot of catch up that has to be done, and so that takes a lot of time. So those are some of the unexpecteds.
All right, Cindy, I have one last question for you. I'm going to ask you to take out your crystal ball here. Mm-hmm. And how do you think InsureTech companies will evolve going forward?
How do I think they'll evolve? That's a really good question. I think a lot of them will become more multi-line because, that's the fun part about building an insurance company. But I caution them on that because you can really lose your focus, right? If you become more multi-line. So play to your strengths. And I would say, make your niche, the thing that you went out with, the vision that you had to make it the best in the market. Keep your eyes focused on that as long as possible. Rally the troops. And because that eventually will get you to profitability. And then once you're in profitability, it feeds your everyday costs. It feeds payroll. It keeps your employees happy. It keeps your customers happy. Keep evolving that product. And new technologies may come out. You really have to pay attention to that. So you have to pay to the competition. You have to pay to pay attention to how the technology is moving and your competition is leveraging different things so that you stay nimble. The other is build around your niche. So what I mean by that, if you are, let's say, a Medicaid company or a Medicare company, how can you do ancillary services that play in that space? Because that's your expertise, and you've got the data that you can actually maybe take some non-risk-bearing activities and build an infrastructure that supports your risk-bearing activities so that you become self-sustaining. The other thing is the evolving. It's your front line typically has the best ideas and how to improve something. So they're your warriors. They're your soldiers. They're out there every day fighting the war. It's not necessarily the people that sit, used to say sit in the ivory towers and kind of came up with the ideas. But I would say the best ideas are those people that are dealing with the customers every single day, whether it's on the claim side or customer service side. And because they're doing the heavy lifting and they're seeing where problems are surfacing. So I think if we're true to everyone having a voice and the diversity of the employee group, I think that will actually be a good way to get everybody and keep everybody involved in building a better product. Does that help?
I think it does. It was great. Well, Cindy, I'm going to wrap it up here. First off, I want to thank you so much for your time and your thoughts on the InsureTech sector. I think your comments were very informative and that our audience will greatly appreciate your insight. So thank you very much.
Sure. You're very welcome. Thank you for having me.